Hello, friends. It's like an icebox in this room. It's me, Dr. E, your favorite man-fin professor. Let me adjust this camera just a little bit. I'm telling you, it's 35 degrees in here. So, let's go over the comprehensive problem, the study session problem, okay? So, on the final exam, the first 26 questions are related to a comprehensive capital budgeting problem, okay? And so I've given you 3 practice problems. This is the third one. And with these projects, you have to do 3 things. First, you have to forecast your cash flows. Okay? And that would be the money you spend on net capital spending, which is property, plant, and equipment, and the money you will spend on net working capital, which is short-term assets and startup cost. And then you have to calculate your operating cash flows, which is your EBIT plus depreciation minus taxes. So you have to raise money and spend money in order to generate cash flows. That's what business is. Okay? So we're forecasting our cash flows. Then we have to determine our discount rate, which will start with the weighted average cost of capital, and then we'll adjust for risk. Okay? And then we do an internal rate of return and a net present value. Okay? So all of our projects are structured the same way. These 3 steps. Okay? And remember, the WACC is the percentage of each type of capital times the cost of each type. Okay? All right. Make sure this is working. Yes, it is working. Let's move on. And let's do part 1, which is forecast our cash flows. Okay? And we'll start by looking at CF0, forecasting CF0, cash flow at time 0. So CF0 is equal to the money we spend, net capital spending, plus net working capital. Okay? So the money we spend on PP&E and startup cost. The short-term assets that we have to buy, the expenses we have until we start generating revenue and profit. Okay? So, a couple of ambitious students want to start a business. A service that helps people identify restaurants that are close by that have food customers are hungry for will then help the customers help set up reservations, order food, get directions to the restaurant. They can ask for their favorite waiters. The fee for the service is 10% of the total bill of the table. Customers will pay 5%, the restaurant will pay the other 5%. So that's the idea. Then we have information that will help us set up our income statement, but that's not what we're looking for. We're looking for net capital spending. They will have to buy 10 computers at $1,500 each. So PP&E equals computers 10 times 1,500 equals 15,000. Okay? So we have that. Furniture, 7,500. All right. A small building. They purchased 20 years ago for $40,000, appreciated in market value by 4% per year. So the building is equal to 40,000, how much they paid originally, times it appreciated 4% a year for 20 years, 1.04 raised to the 20th. And so the building is worth $87,645. That's the future value of the building from 20 years prior to today. So today it's worth $87,645. Then we have land that appraised. So this is the market value of the building at $10,000. Okay. These are relevant costs. They could sell that land and building for that much money. All right. Then we have the software. This is kind of an unusual situation, but we are asking an IT firm to code for us a service, this software, and we could either expense it all in year one, or we can depreciate it over time, or we can include it in cost of goods sold. Those are the three ways we can handle it, and what we're going to do is we're paying the $75,000 up front, so we're going to depreciate it. I think is that 75,000? Yes, 75,000. Then the working capital. So the working capital, let's call it net working capital just to keep it consistent. So the net working capital is $10,000 a month for 6 months, so that's going to be $60,000. And again, there are different ways of handling the working capital. Let's keep it simple and just include it as money spent on assets, not as expenses, because otherwise they'd be costs. So we're going to include it that way, startup costs like that. So what's our total CF0? Okay, so 15 plus 75 plus 87,645 plus 10,000 plus 75,000 plus 60,000, and that is 265,145. Now remember, so we're going to spend all this money. This is how much we have to raise, and we're going to spend all this money up front. This is an outflow. Had several people say, Dr. E, we're getting a different answer when it comes to doing all the cash flows and the net present value. And the reason they got a different answer is they forgot to enter this number as a plus minus, as a negative. This is an outflow. That times 0. Okay? So now, let's go ahead and do our figure out what our depreciation is going to be. What are we going to depreciate? Well, we're going to depreciate the computers, and we're going to depreciate the furniture, and we're going to depreciate the building, but we cannot depreciate the land, okay? We are going to depreciate the software, and we do not depreciate the net working capital, okay? So we have this 75,000 plus 87,645 plus 7,500 plus 15,000, and so we come up with 185, 145. Okay, that's the amount we're going to depreciate. It's a 5-year project with no residual or salvage value, straight line. So our depreciation is going to be $37,029. Okay, so we have our CF0. And now we have our depreciation. So let's stick our depreciation up here, just so we'll remember. 37,029. Okay? All right. Now so we got our CF0, and that's going to be 265,145. All right. Now let's erase all this, and let's do our operating cash flow. Operating cash flow. Okay? So we have our sales and our cost of goods sold and our gross profit and our SG&A and our depreciation and our EBIT and our taxes. And now we have operating cash flow. And operating cash flow is EBIT plus depreciation minus taxes. So let's do our sales. So we have 20,000 tables a year times an average ticket of $100 a table times a charge of 10%, 0.1, and we get 200,000 is our annual revenue. Okay? We are told that the cost of goods sold is an internet charge of $2 per table. 20,000 tables times $2 per table is $40,000. Our gross profit is $200,000 minus $40,000, $160,000. Okay? Our SG&A, we are told that it will cost oh, wait a minute. You know what? The 265,145, let me clarify for you, because there are two ways we can handle legal and accounting. We can expense it, or we can charge it. We can put it in our upfront into working capital. And so the 265,145 includes the $10,000 of legal and accounting. Be sure to, so that's already included in there, $10,000 for legal and accounting. Okay? All right. And you know what? We could expense that, or we can depreciate that. I want to keep this as simple as possible. So the 265,145, we're going to put in we're going to include it in our working capital, net working capital. Okay. All right. And you know what I want to do also? If we're going to do that, then let's include the legal and accounting in our depreciation. Okay, so I'm making a little change here. So that's going to be 10,000 divided by 5 years is equal to $2,000 a year. So we're going to put that up here, 2,000. And we got 39,029. We're going to depreciate it, because we're going to, up front, we'll include it here. It's included in the 265,145. And so we're going to include it and depreciate it here. Okay? All right. So our SG&A, let's see where we are with our SG&A. 35,000. So the maintenance fee of 35,000. So we're going to put that right here. Is our SG&A, and then our depreciation is 39,029. Okay? And so our EBIT was 87,971, but now it's going to be 85,971. Okay? Because we're going to depreciate the legal and accounting expenses, or capitalize, what we call capitalize. We're going to amortize it, actually. All right, so here's our EBIT. Sales, cost of goods sold, gross profit, SG&A, depreciation, and there is our EBIT. So our taxes, our tax rate is 30%. So let's multiply. Let's clear this out. 85,971 times 1 minus 0.3. Or no, I'm sorry. Times 0.3. Times 0.3 is 25,791. Okay, that's our taxes. All right. So EBIT 85,791 plus depreciation 39,029 equals minus our taxes 25,791 equals 99,029. Okay, that's our operating cash flow right there. So we're going to spend $265,145 in order to generate 99,029. So we're spending $265,000 to generate $100,000 a year in cash flow. Okay, for 5 years. So we've got our cash flows. We can go ahead and do the internal rate of return right now because we don't need a discount rate to do the internal rate of return. All we need are the cash flows. But we do need to have a discount rate to compare against our internal rate of return. But let's go ahead. I tell you what, let's wait. We'll wait till we get to that section, section 3, to do the internal rate of return. We'll do the net present value and the internal rate of return. So I'm going to take a quick break here because we're a third of the way through. We've done our cash flows. Now we're going to do our weighted average cost of capital. We're going to do our cost of capital, but we're going to do that in a separate clip. All right, let's take a quick break. Peace out. Shalom.